If you have any questions, please pop it into the chat or the Q&A function that's on the system. We are, as you've just heard, we are recording this session, and we will be sharing the slides afterwards with you. So no need to take copious notes or anything like that. The slides will be also available on our website for you to download. So with that, my name is Colin MacDonald. I am a partner within Deloitte, and I lead our board program. I'm joined by a number of my colleagues on the call who will introduce themselves briefly before they commence their piece. But without further ado, I'll hand you over to Daryl Hanbury, who's our head of tax, who's going to give some oversight in relation to the taxation environment as he sees it at the moment. I'll come back to you at the end for a Q&A, and as I say, do pop them into the chat or to the Q&A button.
Thanks, Colin, and good morning to everyone. My name is Daryl Hanbury. I'm the head of tax and legal here at Deloitte, so I'm not going to take up too much of your time, just a brief introduction of the three topics that we're going to talk about today. But typically when we talk tax, people ask, well, what are the macro issues that are affecting organizations today? I think probably the 3 or 4 key points we always point to: one, the number of elections that are taking place over the course of the year, particularly from an Irish perspective, the UK and the US elections, which will have a direct impact on the Irish economic position. Again, the topic around streamlining of global tax rates, Pillar 2, and it means we need to look at our overall proposition to attract FDI. So you'll hear a lot about the OECD and BEPS when James talks later, but the fact that we need to now continue to attract that FDI, but also double down on our supports for Irish Indigenous businesses, hugely important and topical point. In addition, we're always pointed to the corporation tax receipts, which were 23.8 billion in 2023. Again, most people are aware of the concentration of that sum and those receipts, that 52% of them come from the top 10 taxpayers, which is an enormous dependency. But also, just to highlight that over 85%, almost just over 20 billion, came from foreign-owned multinationals. So it is really important that we continue to improve our proposition. And one of the key areas, whenever we are talking about the Irish tax proposition, particularly in an age where corporate tax rates can no longer be that competitive yardstick, are our personal tax rates, which are still high. They do impact the ability to attract foreign direct investment. They do impact the ability to drive entrepreneurial activities in Ireland. And I think, in particular, as politicians gear up for the elections, I think discussions around surcharges on top of those rates are concerning businesses. And allied with any negative changes to our special assignee relief program, this could have a dramatic effect on attracting senior executives to Ireland. I think the particular issues which we're going to be calling out through our interactions with government, we're finalising our pre-budget submission and are expected to have a couple of conversations once we pull that together. But the 3 key areas are around streamlining the tax system and removing unnecessary complexity. Again, a streamlined and simple tax system is beneficial to business and helps attract businesses to Ireland. We've also called for the use of investment funds and whether that's using the tax regime as necessary to help drive investment into growing areas such as Gen AI and sustainability. The idea being to create those opportunities for the funds to provide more lending options to startups and SMEs who have that expertise. And then the piece which again people will know from their own interactions and reading the media, we need to be quicker in addressing systematic infrastructure blockers to the growth of our economy. Housing, energy, sustainable energy, transport all need significant energy behind them for sure, and they need significant investment. They need leadership in making big and bold decisions. And I think private enterprise has a role, and again, the tax system can assist in that regard. So to conclude my piece and just to pass over to our speakers, why have we picked these topics today to discuss with our board community? Typically when we talk to directors and boards, we focus on governance, controls, and the strategic direction of organizations. Pillar 2, which is our first topic, is a significant impact for many organizations, has a fundamental impact on Ireland's value proposition, as I've mentioned. And I think time and resources will need to be put aside to ensure organizations address what is a highly complex set of rules and regulations. Gender pay gap reporting and pay equity goes to the heart of the gender diversity and inclusion within organizations. And while the reporting is what it is important that organizations demonstrate that the right behaviors are being taken at a firm level to ensure that the gender pay gap is reduced. And I think this is particularly important with the additional reporting, and Anne will walk through all of that. Tax controversy and revenue audits are consistently becoming more and more intrusive and time-consuming, with the use of technology and the availability of significant information from taxpayer filings, giving revenue a significant amount of data to target their efforts. Again, at a board level, the tax control framework reviews that should be done in each organisation are important to see where there are gaps in controls and procedures. We run these independently for our clients to give boards a red, amber, green view of the various items, to allow boards to see at a high level the tax risks that exist within a particular organisation and how they should address them. So I think that sets the scene. I'm going to pass you over now to James Smith, who is going to talk you through Pillar 2.
Thanks, Darrell, and morning, everyone. Delighted to be here. So I'm going to spend some time talking about Pillar 2 this morning, and I'll also touch on another kind of development that also comes up in a lot of Pillar 2 conversations in terms of public country-by-country reporting that's coming into play in Ireland with effect from next year. The topics I'm going to touch on as part of the presentation are, firstly, to give an overview of the way the Pillar 2 rules work, then to touch on the safe harbour rules that are available to simplify matters in the first 3 years. We'll then talk about local country implementation, status of these Pillar 2 rules, touching on a number of examples and the different approaches being taken to implementing these new rules around the world. We'll also then touch on the financial statement disclosure impact of these new rules, both for financial year 2023, which those disclosures have probably passed for most at this stage, but then also looking forward to 2024 and the financial statement disclosures we expect to be required for 2024 financial statements. And then I'll finish then with the kind of overlay around public country-by-country reporting and some of the considerations that come up in the context of Pillar 2 and the interplay with public country-by-country reporting. Ruth, if we flip to the next slide, yeah, that's great. So Pillar 2 is probably the biggest change to the international tax landscape that's been introduced, possibly ever, but definitely in recent times. Who it applies to? It applies to a multinational group with global consolidated turnover of 750 million euros or more in 2 of the last 4 years. There's a number of different rules that can apply, but the overall objective of the Pillar 2 rules is to ensure that multinational groups pay a minimum tax rate of 15% in each jurisdiction that they're operating in. That's achieved through a number of different rules. We'll start maybe with the main rule. I'll then talk about the local rule and then the backstop rule, which all kind of interact. The main rule is one where you look at the top company in the group, or if that company hasn't implemented the rules, you go whatever amount of tiers down you need to go until you identify the top company in the group that has implemented the rules, and it involves that company or jurisdiction looking down through the group to all jurisdictions within the group to test whether the minimum tax rate under these new rules is 15% or more. If it's not, that country would then pick up the top-up tax on those under-tax profits. And that was always intended to be the main rule, but as the rules developed over the recent years, you had a situation where a lot of countries didn't want top-up tax on under-tax profits in other jurisdictions being picked up somewhere else. So, for example, if you had an Irish headquartered and parented group with low tax profits in Singapore, Singapore didn't really want the top tax on those Singaporean profits to be picked up in Ireland. So a lot of countries have implemented what's called the qualified domestic minimum top-up tax. And the way that applies is notwithstanding there may be an income inclusion rule pickup at the top, it gives those other countries the option to apply that top-up tax in their local jurisdiction in respect of profits arising in that jurisdiction. So, and to the extent we do have a top-up tax under a qualified domestic minimum top-up tax rule, then obviously that won't be applied again at the top company under the income inclusion rule. But they're the two main rules we see coming into play for 2024. There's another rule called the undertax profits rule that will apply from 2025. And what that looks at is to the extent a top-up tax hasn't been applied in any company within the group under the income inclusion rule or the qualified domestic minimum top-up tax rule, this rule kicks in then and gives effectively every country within the group that has implemented the rules a right to impose a top-up tax on those undertax profits that arise anywhere else in the group. The typical scenario this can apply to is where you have a non-implementing jurisdiction at the top of the group with a number of subsidiaries that haven't applied the rules. And in this scenario, it would give Ireland or another implementing jurisdiction a right to tax those profits, notwithstanding it didn't have any direct or indirect shareholding in those companies that are generating those undertax profits. So far-reaching impact of this rule for various groups, but helpfully it doesn't come in until 1 January 2025 in an Irish context. There is a fourth rule called the subject to tax rule. Generally, we don't see this applying in an Irish context. It's a treaty-based rule primarily aimed at developing countries, which would give those countries a right to impose a tax on certain payments made to other jurisdictions where the tax rate applicable to those payments on the other side is less than 9%. That rule isn't yet in effect. It will require a multinational or a multilateral instrument to be introduced to give effect to those rules. But the three main rules I think to focus on for the purpose of discussion are the main rule, the local rule, and then from 2025 onwards, the backstop rule. The other key point to mention is that these rules apply to impose a minimum tax rate of 15% in each jurisdiction that the group is operating, unless a safe harbour rule applies. We'll go on now to talk about what those safe harbour rules are. They were initially introduced to very much simplify matters for the first 3 years as different groups are grappling with the rules. And what they do is they try to identify low risk scenarios where they kind of apply to say these jurisdictions are unlikely to have a top-up tax. So for the first 3 years, we're not going to require these jurisdictions to go through the admin burden of having to do the detailed calculations and assess top-up tax in those countries. So to the extent you do qualify for a safe harbour, it's of significant help, both from an admin perspective, but also there is opportunity there to mitigate the impact of Pillar 2 based on the way the safe harbour rules have been drafted. The first one of the three safe harbour rules that can apply, and they're all based on the country-by-country reporting data that will be available for the majority of groups, is called the de minimis rule. That applies where within a jurisdiction, the group has revenue of less than 10 million and profit of less than 1 million. We probably don't see that applying too often, but in some countries where there's not a lot of activity, it can apply to take those countries off the pitch effectively for the safe harbor period for Pillar 2. The next one is the routine profits test rule. And what that rule specifies is that if your profit in a jurisdiction is less than a particular amount called the substance-based income exclusion, which is based on a calculation depending on the level of payroll and tangible assets you have in a particular country. If it's less than that amount, then you would qualify for the safe harbor under the routine profits test. We typically see this applying, say, for example, where you have an overall loss position in a jurisdiction. You generally expect in that scenario the routine profits test to apply, thereby qualifying that jurisdiction for the safe harbor in that country. The third rule, and the one we see being used most, I would say, is the effective tax rate test. And what that does is it looks at your profit in your country by country report, and it also looks at your tax charge, current and deferred, in your financial statements that make up your country by country report. And if your simplified ETR, by dividing your tax charge in your financial statements by your profit in your country by country report, is greater than 15% for 2024, 16% for 25, and 17% for 26, then you qualify for this third safe harbor rule, to again take that country off the pitch for Pillar 2 for the year in which you qualify for the safe harbor. An important point to mention around the application of the safe harbors, they're drafted in a way whereby if you fail to meet the safe harbor in any one of the 3 years that they're available, you can't qualify for them in a subsequent year. So it's called a once out, always out rule. But if you have an accounting fluctuation, for example, in 2024, where you have maybe FX movements, or you have a gain on sale of a subsidiary or something like that distorts the ETR and profits in your financial statements, that could have the effect of disqualifying you for any of the safe harbor tests for 2024, in which case, even when you return to normalized level of profitability and tax in 2025 and 2026, and you would have qualified for the safe harbors in those years, you won't be able to if you fail to test in 24. I think, Ruth, if we go on to the next slide. So we'll just maybe talk about, spend a few minutes talking about the implementation status of the Pillar 2 rules across various different countries. The intention was always that these rules, I think, would be introduced consistently and at the same time. Unfortunately, that hasn't happened. Within the EU, we obviously have an EU directive for the implementation of these rules, which specifies that the rules should come into effect from 1 January 2024 for the income inclusion rule and the qualified domestic top-up tax rule, and from 2025 for the under-tax profits rule. That's obviously the approach Ireland has followed. There's the majority of EU countries have followed that or are in the process of following that. And there are some countries within the EU, like Malta, for example, that has applied a temporary exception from implementation of the new rules based on the number of multinational groups they have in that jurisdiction. Looking at some other countries, the UK has also implemented the rules on a similar basis to Ireland. Hong Kong hasn't. It's announced it's going to go with the 2025 implementation date. UAE similarly is looking at a 2025 implementation date. Switzerland has gone with just an introduction of the qualified domestic minimum top-up tax rule for 2024, and it will look at implementing the wider set of rules from 2025 onwards. That's really a protection measure to make sure Swiss under-tax profits don't get taxed elsewhere under the application of the other rules by other countries. The two probably big outliers are the US and Canada, where we don't yet know what way that will play out in terms of when they might be able to implement the rules. The US have political challenges, I'd say, in terms of getting political agreement to introduce the rules. But there is a particular safe harbor rule separate to the ones I've already talked about called a UTPR safe harbor, which means that profits generated by, for example, a US top co that aren't subject to a top-up tax rule under the ordinary rules won't be subject to the under tax profits rule for the first 3 years based on the application of that particular safe harbor. China similarly hasn't announced its plans in terms of implementation of the Pillar 2 rules, so there's more to play out in that context. Ruth, I think perfect. Just to spend some time now talking about the financial statement disclosure rules applicable to Pillar 2. I'll focus initially on the blue colored boxes, which are really describing what the position is for 2023, and then the green boxes reflect the position for 2024. So for 2023, what was required was quantitative and qualitative information to describe the impact that the Pillar 2 rules would have had they been in effect. And the reason this is different to the 2024 disclosures is that for 2023 we were in a situation where the Pillar 2 rules had been enacted or substantively enacted in a lot of jurisdictions, but weren't yet in effect. So there was a kind of light touch disclosure required for 2023. Overall, we probably saw a lot of groups report no material impact expected from the Pillar 2 rules for a combination of reasons. For example, the application of the safe harbors or just the profile of those profits in particular countries. It's fair to say for 2024, it's a much heavier lift required in terms of the financial statement disclosure for Pillar 2. The disclosures required will first of all need to specify that the group has applied the exception from recognising deferred tax on Pillar 2 that has been enacted, but also they will need to specify the quantum of current tax arising on a kind of per country basis under Pillar 2. So I think what we're seeing is a lot of groups get ready in terms of modelling and assessment of the impact of these rules to be prepared to make those disclosures that'll be required in the 2024 financial statements. Looking forward then beyond financial statement disclosures, the other things we're seeing coming down the track from a Pillar 2 perspective are I suppose obviously getting ready for compliance and setting up the right technology platforms to be able to perform these calculations on an efficient basis, to be able to meet those disclosure requirements in a kind of efficient way, and then also looking forward and thinking about approach to compliance in different countries as a result of these Pillar 2 rules. The first compliance deadline isn't in fact until 18 months after the end of the first year. So we're talking about June 2026. After the first year, it goes to 15 months after the relevant year. So bring the reporting deadline forward to March of that year. But there's a lot of thought going in at the moment in terms of approach to compliance, both in terms of the top co-jurisdiction in terms of the income inclusion rule, but also ensuring consistency with the relevant compliance obligations in the local countries in terms of qualified domestic minimum top-up taxes or under tax profits rules in future years. So it is a big lift, but there will be technology solutions available to support groups with that compliance. Just maybe then to touch briefly on public country by country reporting. So this is something that comes into effect in Ireland. The first year it will apply to will be 2025. The goal is to have disclosure of certain information publicly for impacted groups. It will have to be disclosed on the company's website, etc. The groups that it applies to are groups with global consolidated turnover of 750 million or more in the last 2 consecutive financial years. And the information that would need to be disclosed in that context would be standard information like the name of the company, but also revenue, number of employees, profit, income tax paid, some other matters as well. The information gets disclosed separately for each EU country, And then there's a kind of catch-all for certain countries that might be on the EU blacklist or grey list, or other non-EU countries as well. The reason I mention it in the context of this Pillar 2 presentation is, I suppose, one thing we are seeing coming up a bit at board level is that consideration or discussion around, if I can avail of safe harbour in a particular year to mitigate the impact of Pillar 2, I suppose, how do I feel about the results being publicly available from 2025, and perhaps reflecting an ETR based on that public country by country report of a rate less than 15%. So I'd say I don't think it's just I think a consideration in the context of Pillar 2, but also looking forward to public country by country reporting and thinking about the impact of that in the context of what that public country by country report might look like, and the fact that it'll be publicly available and so on. So I think that concludes the presentation on Pillar 2. At this point, I'll hand back to Ruth.
Over to Anne.
Over to Anne. Perfect.
Okay, thanks very much, James. It was very interesting. And hi, for those people who don't know me, I'm Anne Kelleher. I'm a director leading out our reward services in Deloitte. I sit in tax and legal, and I work for the Global Employer Services division, which is really using remuneration as a strategic tool to support companies attract, retain, develop, and progress their talent. So it's very much how we can help companies with their employees. For the next about 10 minutes, and there's a lot of information on my slides, but you'll obviously get them. I'll really be talking about, I suppose, one area that is gaining a lot of momentum, both across organizations, but also potentially at remuneration committee and board level, is the whole discussion around gender pay, and more importantly, the broader topic on pay transparency, as we have different legislations either in place or coming in over the next few years. And what that means for companies. Ruth, if you could go to the next slide, please. So I suppose my main focus will be, as I said, gender pay gap legislation, but also pay transparency. And I think from an overall perspective at global level, there is a lot of legislation around equality and what paying equally for jobs of equal value mean. However, I would like to stress that we are reporting on gender pay gap reporting in Ireland since 2022 under the Gender Pay Gap Information Act. We are now going to be subject to the EU Pay Transparency Directive come June 2026. That is going to be much more onerous than it is today, not just on gender pay gap reporting, but also on how we communicate pay elements to our employees and also to prospective employees. There is also, I suppose, from an EU Pay Transparency Directive point of view, an awful lot more in relation to anti-discrimination from an employee perspective as well, which really, I think, looks at companies' overall people strategy and beyond in how they are communicating and dealing with both existing employees, potential employees, but also third parties, and I'll talk about that in a minute in relation to pay. But I suppose, in summary, dealing with kind of equality and pay is nothing new. We have seen this in other, continents like Australia, also with respect to Germany, in the EU, and also the US, especially if I take a particular state like New York, where they brought in legislation around in 2017 sharing about the ability to share pay ranges with prospective employees between 2017 and 2021. They did it on a phased-in approach. So you may say this is nothing new, but I do think that the EU Pay Transparency Directive is all-encompassing of what we have seen in other continents and jurisdictions. And also from June 2026, with the exception of some reporting, which will come in 2027, all companies, irrespective of their size, will come under the EU Pay Transparency Directive. So it is quite onerous. And I think, given that we're in 2024, we're just about 2 years out from when it's going to be implemented, and companies have a lot to do to get ready. And I'll talk about that. But just in summary, if we take the gender pay gap reporting, as I said, we currently have to report for companies who are now over 150 employees, will have to report their gender pay gap by the end of 2024. The EU Pay Transparency Directive also has requirements to report on gender pay gap reporting. The classification of data is slightly different, as we know it, under the directive at the moment compared to the current regulations. We would like to think that our government would align those two, so that it would make it more, I suppose, user-friendly from a company point of view, and that at least there was consistency in reporting. I also referenced the Corporate Sustainability Reporting Directive that's applicable from July this year, and that also has requirements for reporting in 2025 on gender pay gap reporting, which is slightly different, as we understand it, than the current regulations. So I would imagine over time, companies reporting on gender pay gap reporting, hopefully from an Ireland point of view, that we will get those aligned. So at least it's clear what people need to report, when they need to report, and also the classification of data. But I do think there is I suppose, an environment in relation to reporting to navigate over the next year or two as those directives and legislations align. I would call out in particular from an Ireland point of view in relation to gender pay gap reporting, where it's at a very aggregate level. Under the EU Pay Transparency, we will talk a lot about it needs to also report gender pay gap reporting at a work category level. So if I look at the directive and if we look at kind of the slide that's in front, I suppose the key elements for me around EU Pay Transparency, and I have a detailed slide in the backup that'll help you navigate this, is from, I suppose, a prospective employee perspective. You need to share pay ranges on what supporting prospective employees to understand the pay ranges by which the job by which you're advertising for, that they know that this is the range it'll work on. Typically, not all companies share those either internally or externally at the moment, but from 2026, companies will have to find a way to share this data with prospective employees. Also, we would assume that any of the hiring processes around hiring are set in a kind of objective, gender neutral criteria process, so that, you know, there is all, I suppose, opportunities available to both genders, and that both genders are considered not just in kind of the interview stage, but also in the job description stage, so that there's no biases contained. In relation to sharing information with current employees, employees will have the right to ask for their pay levels within the job category by which values job of equal value. And they'll also be able to ask for the gender pay gap of that category of worker by which they operate in. This will require companies, and especially when I come to talking about gender pay gap reporting, it'll really require companies to look at their systems and processes around how they categorize work of equal value, so that they have the ability to pull data to measure those jobs of equal value, and that can stand up for scrutiny both internally and externally, because employees can ask for this data either through directly themselves or through employee representatives. And that brings a completely different focus in relation to sharing of data and the mechanism to do that. Also, employees are entitled to receive the data within 2 months of requesting it. They're also entitled to receive it in writing. If they have any queries, they can use their employee representative, or they can go directly to ask for further clarity. So as you can appreciate, where companies may have very good direct engagement models, or if they're in a unionized environment, they may have very good communication methods already with the unions and employees. But I think this is an area that will be of huge focus. So it's not just what data you're going to share, it's how you're going to share it. And also, can it stand up to scrutiny, and that you have the correct governance in place in order to make sure all your checks and balances are done internally. From a gender pay gap reporting perspective, as I said previously, companies that have over 150 employees will have to report on gender pay gap reporting in 2027. How remuneration elements are categorized under the directive are slightly different than we're seeing under the current Gender Pay Gap Information Act 2021 and Regulations 2022. For an example, where you'll have to report on the mean and the median on pay, also on what they now call complementary pay. In relation to the directive, they're also including the value of benefit in kind. Under the current regulation, we don't include the value of benefit in kind in the calculations. We do share a percentage of employees, both male and female, who receive benefit in kind. So I think it'll come under question, what is included in benefits to be valued? How do you value them? And you can imagine, I'll just take a quick example of whether it's a defined benefit or a defined contribution plan. How do you value that? So there is going to be a lot, I suppose, of scrutiny on the data and what's included. Also, from the EU pay transparency perspective, the first requirements in 2027 to report are based on 2026 data. We know at the moment under our current regulations that companies pick a snapshot for data between June 1 and 30th and look at the 12 months preceding on remuneration elements. We don't know if that's how the Irish government, when they transpose the directive into law in 2026, are going to align them. We're absolutely hoping they do, and we will lobby to that effect. I think the also important element that's very different under the EU pay transparency is that you will need to understand your gender pay gap by work category. What does work category mean? It means your ability to value work, to categorize work of equal value. So that comes up to a lot of discussion around what is work of equal value and at what level do I do that. You'll also need to make sure that you have the systems like job architecture, job leveling in place, where you're pulling data from different elements. We already know from working with companies under the current regulation that the data management, the data mining is the most difficult part for companies, because they're often pulling from 3 or 4 systems to get the data in order to support the gender pay gap reporting at the moment. If your gender pay gap, if your adjusted gender pay gap, and I have a slide in the backup that talks about unadjusted pay gap, which is what we're doing in relation to reporting gender pay gap at an aggregate level at the moment under the regulation, you'll have to look at what your adjusted pay gap is. And if that adjusted pay gap is greater than 5% and you haven't got a mitigating plan to deal with it in 6 months, then you're into joint pay assessment with workers' representatives. So that is very different from how companies operate at the moment. And what we're seeing with a lot of clients, and especially questions coming up at a remuneration committee level, but also at the board level, is how do they utilize 2024 and 2025 to understand if they have adjusted pay gaps, which is really to make sure that they got equal pay that is basically manageable and that they can explain under objective gender neutral criteria. So they're really using, I suppose, the next 18 to 24 months to understand if they have any gaps in their organization and if adjustments need to be made. I think one of the things as well that will come out of gender pay gap reporting, looking at it by work category perspective, is how are your remuneration elements in your company working? So how are you looking at pay levels, pay structures? How are you, I suppose, connecting your remuneration strategy and policies and programs to your bigger strategies around people and talent movement? Also, Daryl had mentioned earlier in the introduction around where does this play in your diversity, equity and inclusion strategy. And I think also now, obviously in your sustainability strategy for companies, how are you linking some of your metrics around, I suppose, gender pay gap, etc., into those core reporting responsibilities. One element of the directive, and I won't go into it in a lot of detail, happy to discuss with anyone after, is the whole justice for victims around pay discrimination. So just a few elements to call out on that. Under the directive, if employees are found to be discriminated against, then they are entitled to full remuneration compensation, both on base, variable, etc., and also looking at the time span it's involved in. The other difference under the directive is that employers will have to prove that there's no discrimination in their system. Obviously, there will be, we understand, significant fines in relation to companies who are not compliant to the directive. Currently, under our Gender Pay Gap Information Act and regulations, there is no financial penalty if companies don't comply. Obviously, I think what I'm seeing from most of our clients and looking at the industry, there's a greater desire for companies to use gender pay gap beyond a compliance tool to really use it strategically to drive that whole inclusion strategy. But I think there will be bigger fines because the EU Pay Transparency Directive has mainly been put in by the EU because they don't feel that the equal pay legislation is making companies work fast enough in this space. And also they want to have a platform that's standard across Europe to give employees that platform to demand equal pay for work of equal value. So they're the kind of key elements. And I think I wouldn't underestimate either the role of the worker representative in this whole, I suppose, pay transparency from a company point of view. And I think that really does have an employee relations and an employee engagement opportunity here on how companies engage with employees. The other element of the directive that I would call out is around communication. Under the directive, it's the employer's responsibility to communicate on an annual basis to employees their rights under the directive. So that is very much how companies will then look at that as an opportunity to engage their employees around pay transparency and what they're doing in this regard. But also it'll require a lot of governance so that companies can make sure they have the right communication strategies, but also, and we know nothing is static in companies. Companies do change their reward strategy for different reasons, their pay levels, etc. It's how, when you make actions in that regard, that you're understanding the implications beyond reward and into other, I suppose, strategies from a company point of view. And what does that do to your data so that you can be proactively moving, I beg your pardon, proactively managing the decisions you make and understanding the implications of it. Not that you won't make the right decisions, but you're more, I suppose, managing the risk and the implications of those decisions. Next page. And Ruth, next page, please. I'm just very conscious of time as I want to give Fiona time as well to talk. But I suppose what I've really tried to, I suppose, call out here, if I look at from non-executive directors, especially those who sit in remuneration committees, but also senior managers on, I suppose, at a very high level, if you're not sitting in human resources or human capital, it will touch other areas of your business. So I suppose from my guidance would be very much understand the directive and take time to understand what it means for your companies. Really, we are encouraging companies to look at what is the key, I suppose, gaps or risks they see from understanding the directive, both in relation to pay, but also discrimination. And I suppose prioritize what those actions would be, having done a full risk assessment of what they would mean. And I also think it's starting early to understand what would this mean like to communicate to your employees and what you want this to say and how you deal with this, what you want this to say about your culture and your values. I often say, depending on where you are in the journey around gender pay gap reporting and transparency, there will be a degree of change. That could be very small to very large, depending on how proactive you already are in this regard. And also, especially if you're a part of maybe an international or global company that has done this in other jurisdictions, they may have a global framework and you may be already fairly well on in this journey. For other companies, they may only be starting, but it is manageable to do this. I think obviously I've spoken already around, I suppose, the ownership around systems and data so that you can measure gender pay and also do it at a work category perspective, and that you're ready to communicate and work probably proactively with workers' representatives so that it's a collaborative approach rather than being sort of reactive with workers' representatives if there is an issue identified in time. Obviously, understanding the integration and interdependencies between all of your strategies, and obviously, really do engage this strategically as a change to be good around your culture and your brand. And then I can't stress, obviously, with this community, the understanding, not just around the directive, but understanding what risks it may potentially bring forth to companies so that there's mitigating plans in place. And then that obviously companies can prioritize those actions that have the biggest impact. Because obviously there is many things a company can do, but if you understand the risk and the biggest impact, then you can prioritize those to get the good wins out front and be nearly, say, 80% ready before you go in even to 2025, so that you can size it, I suppose, so that companies really understand where the focus is. Next slide. The one point I would say in the next slide, please.
And I'm just conscious there of time. I wonder, should we pass on to Fiona and then we can give them your slides and the materials?
Perfect.
Is that okay, Anne? Thank
That's
you.
perfect. The
Thanks,
only
Anne.
thing I would say is use 2024 and 2025 strategically to be ready for 26. Don't wait until 2026 to be ready for the directive. Thanks.
Okay. Thanks, Anne. I obviously, I'm the blocker between finishing and asking some questions, so I certainly try and work through just some key issues in relation to managing controversy. My name is Fiona McLafferty. I'm a managing director in tax controversy, and I suppose I'm delighted to have the opportunity to contribute to the webinar today and giving this brief update on what is happening in the area. I suppose just to start on this first slide, it really is just looking at certain key developments within the Revenue Commissioners and the Tax Appeals Commission in recent years. The Revenue Commissioners reorganised its operational structure in 2018 and moved to 5 national divisions, which are built around defined taxpayer segments. And at the time, the Revenue Commissioners indicated that the restructuring was designed to optimise the alignment of their resources to risk. And certainly, this theme of risk is a prominent feature of a new code of practice, which came into effect on the 1st of May, 2022. There have been previous versions of the code of practice, and essentially it's guidelines informing taxpayers how the Revenue Commissioners intend to interact with them during a tax audit. And at the time, the chairperson of the Revenue Commissioners described the underlying philosophy of the new code as essentially come to us before we come to you. And certainly their move towards that risk-focused is apparent throughout. Then just in relation to tax disputes, the tax appeal process has been prescribed in legislation since March 2016, meaning the litigation involves specified documents and moves in a defined manner. Certainly in recent years, the legacy backlog of appeals has been cleared and appeals are progressing in real time. Then just on the next slide to show some context to compliance interventions from a Revenue Commissioner's perspective, I think if you compare the number of interventions for 2019 and 2023, and then you compare the yield from those years, I think the Revenue Commissioners themselves would consider that moving to being more risk focused has certainly been a success when you look at those numbers. Then just, I suppose, in terms of the next slide, the current issues of interest, I think something that Daryl has mentioned, it's important to appreciate the evolution in tax administration as we know it. There is an ever increasing range of data sources available to the Revenue Commissioners, which certainly facilitates this risk profiling for more targeted compliance interventions. And remember, this includes third-party sources such as other tax authorities, financial institutions, and third-party returns. And the sources are not confined to information received by Revenue. So for example, you'll know that the Companies Registration Office and the Land Registry are online, and certainly the Revenue Commissioners have deployed technology to scrape information from those sources. And on top of that, there are also EU and international initiatives which are driving increased cooperation between tax authorities. And I think in my view, you could almost describe the Revenue Commissioners as a technology company whose business is to collect taxes. And this impact of technology, we can really see in their expansion of real-time compliance checks and the deployment of e-audit as a means to understand and interrogate taxpayer information. And certainly you will have seen in recent years, this is particularly evident in employment taxes, and that really has been driven by the investment by the Revenue Commissioners in PAY modernisation. I suppose, in short, what am I saying? It's the Revenue Commissioners have access to more and more information, and the sources are growing. And as James alluded to, the country-by-country reporting, more detail being required in relation to that. And really, from a tax audit or compliance intervention point of view, it's really understanding or knowing the information sources may assist you in understanding the lens through which the revenue officer may be looking at the issue under examination. Then I suppose as regards the areas of focus, an interesting feature in recent years is the inclusion in budget papers of specific references to yield from compliance interventions. So in budget 2023, there was an estimated yield of 80 million from a range of targeted interventions with a focus on PAYE and share schemes. The revenue commissioners were more ambitious in budget 2024, as the figure was an estimated yield of 120 million in the areas of e-commerce, payroll and expenses, and the cash and shadow economy. As you'll appreciate, it's impossible to give a comprehensive or definitive list of potential issues of interest, but based on our information extracted from our own internal revenue intervention tracker, in addition to those referenced in the budget, I've listed there a number of areas of focus, and certainly in the interest of time, I'll just highlight one or two. Certainly transfer pricing, we're seeing the deployment of the arm's length principle, and we're also seeing using those arm's length principles in challenging pricing arrangements between connected parties in non-transfer pricing situations. And one issue that may be of interest to this audience, I suppose, is we're seeing an increase in inquiries on control and governance procedures. Things like, is there a tax control framework in place? And perhaps you may be thinking, well, is this straying beyond what a tax authority can ask? Should their focus not be on whether there is or is not a tax liability? But I think from the viewpoint of the revenue commissioners, it is that they believe taxpayers should be delivering a tax return which discloses the right amount of tax at the right time. And if this is not happening, then what needs to be done to address, what needs to be addressed to ensure that this is happening? Then just on the next slide, in terms then of compliance interventions and how do you prepare yourself for doing that? Certainly, when you look at the intervention notification, it will tell you, ask you certain inquiries, but certainly from a risk perspective, you really want to be looking at it perhaps with a wider lens. So the notification will identify the level and the scope of the intervention, and you want to consider whether there's any possible contamination or link to other entities, other periods, or other tax heads, as this really could have a bearing on the qualifying disclosure that you may wish to make. It will also identify the focus of the intervention. And again, you want to consider whether there are any potential issues which could lead the revenue officer to escalate the examination to wider issues, and really what impact this may have on any disclosure. And again, you may be thinking, why do I keep emphasizing the qualifying disclosure? Well, qualifying disclosure comes within the statutory exclusions from publication on the tax defaulters list. So the disclosure is significant, as invariably avoiding publication is a key concern to safeguard reputation. Then just, I suppose, the notification will also identify the timing for any disclosure. You need to consider whether there is sufficient information available to determine whether to make a disclosure and how to manage a request for an extension. And then just in terms of thinking about those risks, in terms of managing the reactive, so I would say engage early with the revenue commissioners to manage the intervention process. I think it is important to have an awareness that, as well as analysing the books and records in the context of the issue under examination, the revenue commissioners will be evaluating the broader behaviour of the taxpayer. And this is where the question of tax controls and the governance environment comes into play. And really, this evaluation may flow through to the revenue officer position on penalties, which ultimately impacts on the publication on tax defaulters list. And then just, I suppose, to finish with, moving to what I would see to be more proactive. So in my experience, I think it can be advantageous to shift your thinking to that. As I said, it's generally when you have no choice in being a participant in a tax audit or tax dispute. Unfortunately, the brown envelope has landed on your desk, that you focus on what is involved. And the timings are short. You have only 60 calendar days to make a qualifying disclosure. And you might say, well, what do I mean by a proactive mindset? Well, I think it's important to remember the explanations that you give in a tax audit and the evidence that you present in a tax dispute are facts which are created and exist in the implementation of a transaction, which are recorded in the documents and captured in your systems, and certainly then disclosed in tax returns. I always describe it just as a tax audit and a tax dispute involves the deconstruction of a transaction. So you have the tax authority forensically examining the explanations and documents to test the facts and establish if the tax position is correct. And I think if you understand what is involved in that tax audit and tax dispute, that can be informative in the construction of your and documenting of your transaction, and certainly in the disclosure of your tax position, and really undertaking a risk assessment to identify potential gaps in that deconstruction. So certainly spending time at the beginning can have a significant impact on the outcome of at the end. And with that, whistle stop. I'll hand back to Colm to close out.
Thanks a million for galloping through that as quickly as you possibly could. I certainly think from all of our speakers, the next 2 years, 2 to 3 years are going to be very busy in terms of planning for these changes. There are a number of questions there. James, do you want to take your two questions, but a number of questions in one of them?
Yeah, perfect. So thanks for the questions, guys. The first one I'll address is just the question of whether there's any sign of the safe harbors being extended or made permanent, or is it likely they will just be transitional? I think there's probably a sense out there that a number of the safe harbors are a kind of one-way bet. So I think we would see it as unlikely that the simplified ETR or routine profits safe harbor will be extended in their current form. But we do know the OECD are still thinking about the availability of some permanent safe harbors. But I think there will be, if they are introduced, it will be a modified version of what's there already. The de minimis safe harbor is obviously already there in a kind of modified form within the law on a permanent basis. Instead of taking your country by country reporting revenue and profit for the current year, you take your globe income and profit for a 3-year average period, and there is a de minimis exclusion already baked into the rules. So that's a kind of quasi permanent safe harbor for that. The next question was around whether Pillar 2 eliminates the need for Pillar 1. I don't think it does. I think there's still a lot of political momentum behind getting Pillar 1 agreed. It obviously applies to, there's a different test in terms of who it applies to. 20 billion global consolidated turnover with a profit margin over a certain threshold. And it does something slightly different to Pillar 2 in that it allocates taxing rights to market jurisdictions rather than adjust the tax rate. So I think I think subject to a number of political uncertainties around Pillar 1, I think it is kind of, it's different to Pillar 2, and you could see a scenario where both are brought in. And then in terms of likely dispute mechanisms on Pillar 2 and when would we expect disputes to arise, that is an area that the OECD have said they're currently still working on. There's a number of areas where that's by the nature of the rules are somewhat uncertain. For example, the availability of safe harbors can be challenged by another country for a 3-year period. And there's other things like domestic general anti-avoidance rules that different countries have implemented, and what way will they interact in relation to any Pillar 2 tax planning that's undertaken. So at the moment, we've been told that there's work ongoing as to how that dispute resolution mechanisms will work, but we don't yet have a concrete timeline on that, unfortunately.
Thanks, James. And Anne, there's a question there for you just in relation to some modelling.
Yeah, that we have a pay equity platform that can support multinational companies look at their data across jurisdictions, but also to the second part of the question, companies are using this year and 2025 to understand if there is a cost in adjusting any pay so that they won't be into pay assessments come 2027 reporting. So happy to discuss with anyone offline if they want more information.
That's great, Anne, thank you. Just what we'll do is we'll put the contact email of all of our presenters today, and clearly, as always, we'd be happy to come into your organization to have a discussion on this, or to come to some of your boards if you'd like some further information. So with that, and bang on time, I wish you a good afternoon, and thank you again for joining us, and we'll see you soon. Take care.